Calvin Lee is joining us right now on the show. He's the Editorial Director, Asia and Middle East, S&P Global Platts. Let's begin by talking about Al-Falih's statement, which indicate a possibility of extension of output cut deal. Now, with Iran's supply getting cut off, are we looking at an extension?
So what we are seeing and hearing from the market is that there is a suggestion that the OPEC as well as non-OPEC is expected to extend the sort of agreement that they have in place. So if you look at the Dubai crude price, which is an indicator of where heavy sour crudes are priced, they're showing a really strong market structure. So for the prompt month versus further forward months, it is now at a backwardation of about $1.80, which is higher than what, in terms of the market structure you see in light sweet crude such as Brent. So the market is actually showing or demonstrating value that there is an expectation that the sort of agreement that is in place will be extended.
How is the supply currently looking now that Saudi and other OPEC countries have cut production, plus no Iran oil is there in the market?
I think where sort of OPEC is looking at in terms of global supply is that there is increased crude oil production from the U.S. in particular. So U.S. is now producing at very high 11 million barrels per day levels, and they are exporting substantial volumes, right? So as far as they're concerned, there is increased supply globally, and that's what they're looking at. And in terms of demand is really starting to look to weaken this year. I mean, all the different geopolitical factors, U.S.-China trade tensions, they are starting to have some impact on overall demand. So they're worried on the one hand with increased supply coming to the global market, and on the other hand, sort of demand coming off earlier projected levels. So they want to look at how they can sort of balance the supply to the marketplace in order to make sure that the global inventories not climb to a very high level.
Should we be concerned about lower oil demand, especially if the global growth is slowing down?
So, I mean, this year, even without those factors in the background, the likes of China, as an example, would not be growing at such high rates that they have been growing in the past, right? So, overall, demand from China as well as Greater Asia is expected to ease this year already, right? So there are, regions or countries within Asia that will see a modest sort of increase in terms of demand growth, such as India, but that's not enough to sort of absorb the sort of drop in demand from other countries such as China. And then now with this U.S.-China trade tension, it's going to take a bigger bite out of China's overall demand for this year and possibly going into next year as well, right? So with this, it's really starting to sort of worry the oil market from the demand perspective. Supply is fairly healthy, but I think the focus now is really on demand and focusing right now on Asia. But, if China's overall economic growth it starts to decline, whether that's going to impact all the other secondary economies that depend on China for trading. So that's one of the main factors that is really sort of impacting on the global crude oil market.
Brent is getting very difficult to predict in this in the beginning of the year. The markets were expecting 75, but now it's at 62. How should one go ahead and look at targets of Brent?
So I think our analytics group, they have a forecast of Brent to be around $65 to $70 a barrel for the second half of the year. And you are right that there are a lot of factors out there that potentially could have an impact on global crude oil price, and they've been very volatile in recent months. And I think the markets are really sort of edgy and nervous about how geopolitical concerns, security sort of issues, as well as trade tensions would have an overall impact on global economy. And if they start to have a negative impact on global economy, then that's really going to filter down to their demand for oil. And as such, oil prices have been sort of very volatile in recent months. So the markets will react to any news that could have sort of an indication of weaker demand going forward. But in the second half of the year, I think with the sort of impending IMO 2020 regulation on sulfur or bunker fuel by the shipping industry, that will force the refiners to switch to use light sweet crudes more. And with that, that's going to support the price for Brent being higher than, slightly higher than where it is now.
Thanks so much for taking out time for us. Always good, Calvin, to get any perspective from you.